The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello, welcome to The Trade. Let's first get across the international news with Donald Trump and UK Prime Minister Keir Starmer to meet in Scotland with trade and Gaza on the agenda. And they're hosting at Donald Trump's golf resort in Western Scotland with talk further on a recent bilateral trade deal and that worsening hunger crisis in Gaza. And dozens of ministers will gather at the UN on Monday for a delayed conference to work toward a two-state solution between Israel and the Palestinians, but the US and Israel are boycotting the event. Thai and Cambodian leaders head to Malaysia for peace talks. And in other news, there's a talk of an extension perhaps to those trade talks between China and the US. Well, let's get across what we're seeing on the charts now. David Scutt joining us from StoneX. Scutty, welcome back. Good to see you. Of course, trade front and centre at the moment, with Donald Trump striking yet another trade deal, this time with the EU with a 15% tariff. Of course, it looks as though that once again is in favour of the US.
G'day, Andrew. Good to be back. And you're 100% right. It does look to be very heavily skewed again towards the US advantage. But when it comes to a market perspective, the one thing that's really interesting at this point is the market reaction today. Nowhere near like what we saw back with the Japanese deal last week, which really gives you a sense that markets have already gone and factored in a large probability of this taking place. So interesting to see where risk assets go more broadly, where safe havens go more broadly right now, because a lot of good news looks to be already factored in.
All right, so what does this mean particularly for the Fed? And the likelihood it's going to cut this year?
Well, that's the kicker, because, of course, at the moment, we've got Donald Trump has done a very successful job in trying to go and communicate that this is a great deal for America, where the realistic view is that you're talking about a 15% import tariff tax that's going to be paid by US businesses. That eventually is going to start flowing through to prices. At the same time, because he's done such a great job, the deal that he's presented here, we have risk assets really buoyant at the same time. So you put those two factors together, and it points to the probability that maybe the Fed won't need to even cut rates once this year. At the moment, you see Fed funds curve is currently pricing in 38.5 basis points worth of cuts. And you can see at the moment, that's the lowest level since February of this year. And if we start to see some strength coming through in other economic indicators, especially in inflation, watch that dwindle further. So that could be a fly in the ointment for the risk rally we're looking at.
Now, of course, this comes in the wake of also a Senate deal done with Japan. Look, a couple of factors playing out for Japan, aren't there? Not the least being that trade deal, but also the political instability in the country.
There is. Of course, we don't know whether the Prime Minister is going to go and remain in place. Shiba, for the time being, says that he's going to go and stick around, but that will be historically against the precedent that we've seen in the past. So we'll see what happens, of course, if lost both control of the House and the Senate there in Japan. What it comes down to the Bank of Japan then is they've got every excuse to go and sit on their hands and wait right now. The key difference between what the Fed will do this week, where there's no forecast, is the Bank of Japan has forecasts out. We know that inflation near term is likely to be revised sharply higher on the back of higher food prices. But will that extend through to 2026 and 2027? That will be the key thing for traders to watch, particularly in Japanese markets. If they signal that we've got inflation back or exceeding its 2% target again, going further out, that could go and spark some concern on the downside for risk assets, likely going to lead some pretty acute strength coming through in the yen. So keep a close eye on that on Thursday this week.
All right, so you're saying it's all relying in the data too, with a very big data week this week, including it here in Australia, with the release of that quarterly read on inflation.
Yes, it's going to be a huge data week. When you now have this trade deal that's being put in place with the EU and the US, it means that when you look at all the other risk events, including the Fed, including the Bank of Japan, including the Bank of Canada, they're nowhere near as strong risk events as to what the information that could change that, which is the data. And so what we've been looking at here, much like in the United States, on the top pane there, you've got basically IB futures here in Australia, looking at how much is being priced in for the RBA to go and cut rates over the course of this year. And we still have more than 2 full cuts being priced in, which is considerably a lot considering the RBA has shown its hand and is really reluctant to go and cut rates without really strong concrete evidence that inflation is coming down. And you can see that with the shape of the 3s-10s curve down the bottom there, flattening out, which indicates that expectations for nominal growth are starting to go and slow down again. So this week, if we go and get a 0.7 or above, particularly if it's north of 0.7 for that trim mean reading, look out, because I think the markets will have to go and reassess just how quickly the RBA will be cutting rates this year. At the moment, 2 and a bit cuts still looks a little bit punchy, in my opinion.
Now, Scutty, interested to see what's going on at a commodity level, particularly iron ore, and those iron ore miners having done well recently because the iron ore price has risen above $100 a tonne. The question is that likely to persist given what you're seeing fundamentally?
Well, what we're seeing at the moment is just all too familiar when it comes to Chinese commodity markets. More broadly, we're seeing massive overcapacity across a lot of these industries. We have big iron ore stockpiles in place. And it's not just for iron ore, but we're talking about coke and coal. There's been really depressed prices for a while. There's been some moves in China to go and try and alleviate some of that downside pressure by rationalising supply. And we see this huge rally, both in iron ore started off, then went to coke and coal, thermal coal, and the like. Lithium got involved as well. And then, of course, what happens to go and quell that price rise, which encourages production? What we're seeing is the authorities have moved in and placed restrictions on trading activity. And so it's all unwound again. So when you look at SGX iron ore, which of course is probably a little bit more stable contract, right now it's sitting at a pretty important level on the charts. 101.50 is where that uptrend kicks in. It bounced off that today. But when you look at the momentum signals, you look at the recent price action, you can see at the moment that from a longer term fundamental perspective as well, it's hard to see iron ore remaining above $100 a tonne. So keep a close eye on 101.50. If it's broken, then we're talking about the 200-day moving average, and also we've got horizontal support at 150. At this point in time, I'll be selling rallies in iron ore and a lot of those bulk commodity contracts.
Now, of course, that strength in the iron ore miners has helped the broader market higher. The question is, can that momentum continue?
For the time being, it can, and we're seeing that from a technical perspective as well. This is a weekly chart of SPY futures, and you can see at the moment it had been trading in an uptrend, still is at this point in time. And then what we saw is that at 8,600, the price popped through, we got those record highs, and it's come back and revisited that level again today. And then you're seeing it's bounced off it again. So that's the key level to go watch on the downside right now, 8,600. If that gives way, we're talking about 8,400, and then 8,280 is the next level, which will be a little bit more pronounced as a support level. But for the time being, it's still a buy and dips play. But I just want to reinforce at this point that when you look at the price action, you look at the momentum signals right now, it looks very, very, very mature. What's going to be the catalyst to drive it higher from here if we don't get those rate cuts coming through from the RBA? It's probably not going to come from earnings, so that makes it a little bit cautious up at these levels.
Scutty, great to get across the charts. Thanks for joining us on StoneX. And that is the trade.
The trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.